Welcome to the AI and the Future of Housing Equity session of the National Housing Conference, Tech and Housing Symposium. I am Michael Akinwumi. I lead the Tech Equity Initiative at the National Fair Housing Alliance, the country's only national civil rights organization dedicated to solely eliminating all forms of housing and lending discrimination and ensuring equal opportunities for all people. Through its home ownership, credit access, tech equity, education, member services, public policy, community development, and enforcement initiatives, the National Fair Housing Alliance works to dismantle longstanding barriers to equity and build diverse, inclusive, well-resourced communities. A recent Washington Post article tells a story that I think highlights why the housing industry and mortgage industry should prepare for and benefit from the emerging widening diversity in the United States. America's demographics are changing, and while home ownership gap is a real problem, and the people of color are grossly underrepresented in mortgage approval data, we believe that responsible and equitable use of AI or machine learning is a solution to closing the home ownership gap. Joining me to discuss how AI may be used responsibly to assure housing equity are Phil Bracken, the Managing Director of VantageScore Solutions, where he has responsibility for the mortgage, marketplace, and government and industry relations, with the primary responsibility of advancing VantageScore in the mortgage industry. He was previously Chief Policy Officer and Head of Government and Industry Relations for Radian Guarantee Mortgage Industry, the largest private mortgage industry company in the US. Next is Sheree Garner, who currently serves as Regulatory Counsel, Government Affairs for Rocket Mortgage, where she provides legal counsel and oversees analysis of legislation, regulations, and other policy developments at the local, state, and federal levels in support of the ROC Central Government Affairs team and the ROC family of companies. Prior to joining Rocket Mortgage, Sheree served as Legislative Director and Counsel at NFHA, followed by Ethan Dornhelm, who is currently a Vice President in the Scores and Predictive Analytics Unit at FICO, where he is currently responsible for the analytic development of FICO scores globally. Prior to FICO, Ethan served as a Director in the Credit Risk Management Group at American Express and focused on underwriting strategies in the consumer card business. Last but not the least is Teddy Flo, who is the Chief Legal Officer for Zest AI, where he leads legal, policy, and compliance teams and handles partnership deals, M&A transactions, contracting, employment issues, litigation, regulatory exams, and engagement with external stakeholders. Prior to joining Zest AI, he spent more than a decade in DC as a legal advisor to dozens of consumer financial services companies. So please join me to welcome all the panelists as we discuss how AI may be used responsibly to assure housing equity, both in present and also in future. So my first question will actually go to Phil. So Phil, I'd like you to give us an overview of what the mortgage market looks like currently, how it has changed relative to its state prior to the 2007 financial crisis, and where we should be focusing our attention for new home owners utilizing technologies. And more importantly, how to sustain the attention on closing racial home ownership gaps. Phil, over to you.
Thank you, Michael, and thank you to the National Housing Conference for allowing us to provide some insight about this chronic issue that we're all dealing with. I would label it a crisis. I believe it is, and I believe most of us believe so. Let me give you a couple of statistics. The Harvard Joint Center for Housing tells us that nearly 80% of the new household formation in America over the next 20 years will be people of color. And frankly, we must engineer policies and programs and process and services to, and policies, I might add, to meet that need, because if we're not meeting that need, we're not meeting the need of America. it is unfortunate, but we have atrophied over these last 10 years to a point where home ownership has become much more difficult for especially the underserved markets and people of color. The disproportionate advancement of opportunity has just left numerous people out of the realm of home ownership. I might just reference the National Association of Home Builders Priced Out Index, which says that nearly 60% of the consumers in America can't afford a first-time property. We've got to change this paradigm. We have to. I believe that the use of artificial intelligence and machine learning can give us a chance to meet the needs and close the gap in the areas where it's most essential. And sort of like VantageScore, we are working very hard to deliver a broader opportunity for people to meet to obtain a credit score in the marketplace, to be able to get in the mainstream of credit services and eventually graduate to home ownership. I believe that with the use of machine learning and artificial intelligence, we can score 37 million people that are having difficulty getting a score through other models. That's really important for especially the underserved marketplace. Nearly 13 million of those people would have a score of 620 and up and might someday soon be mortgage eligible. We have never been in a situation where the stars have more aligned than they are right now. And I believe that with the technology advancement, with the opportunity to gather consumer permission data, with the intelligence that we have through artificial intelligence and machine learning, we can create a different paradigm for these people that are most in need. And I hope that we can all rally together to meet that need. As I mentioned before, it is extraordinarily compelling, and I believe we're in a crisis environment that needs to be fixed.
Thank you, Phil, for sharing your insights and more importantly, setting the stage in terms of what the current mortgage industry actually looks like and why it is also essential for the industry to actually take advantage of AI or machine learning and other data out there, so that at least the historically underserved market could have access to mortgage and other financial products. Now, my next question goes to Sheree. So if we want to benefit from Phil's insights or suggestions on current mortgage market, we need to understand some of the barriers that currently exist for mortgage access. So can you please share some of these barriers with us? And in addition, while historical systemic exclusion of people of color could, arguably be considered as a major cause of the underrepresentation in mortgage approval data, just like Phil mentioned, how do you think using alternative data in the underwriting process for loan origination could be of help to this underserved market?
It could be very, very impactful, because one of the things that we've noticed is that, when we're examining from a lender's perspective, examining the racial wealth gap and the racial home ownership gap, some of the traditional barriers to access to credit have been the way that traditional credit has been examined, and borrowers of color often don't qualify for certain things because they don't fit in the perfect credit box model. And so when we are looking at innovative ways to kind of expand and open that credit box, the use of alternative data is really important, but it's a barrier for us because we're limited by what the government-sponsored enterprises allow us to use in the underwriting process. So when we're looking at things like rental payment history, employment history, gig economy workers, the economy has changed in such a massive way in which, using a traditional W-2 9-to-5 job profile for a borrower is no longer necessarily the case. You have a lot of people that have self-employed income or self-reported income. And so using things like that to kind of move the needle to expand it responsibly, because that's the thing. We want to make sure from a lender's perspective that we're always doing it in a way in which the person is qualified to be able to borrow, but they might not be the traditional borrower in the sense in which we have become accustomed to. And so using alternative data is one of the ways in which we know could be effective. And it's not just limited to just borrowers of color, but anyone that has had some type of setback or they don't fit the traditional borrower profile. It could be helpful in expanding that in opening the box for people to be able to borrow. Would you mind repeating your second question so I can answer that one as well?
Yeah, sure. My second question was about the role that alternative data could actually play. So you already touched on what's called the first question, talking about the different barriers, right? And it's just like Phil mentioned, right? So we're in the era of big data. And besides the standard data or the industry data that you have, you also touched on rent payment data and all that, right? How do you think that could actually help to make sure that we serve the historically underserved communities or consumers?
Well, again, when we're looking at borrowers of color, we're talking about things, when we're talking about people in communities of color, and I feel like I'm uniquely positioned to speak to that because I know from a generational perspective and seeing people and members of my own family or folks that I know, I'm from Detroit. It's one of those cities that's kind of like a test case for how borrowers of color have been historically shut out of the process and not necessarily understanding the role and the impact that traditional credit can have on a borrower's ability to be able to purchase a home and the significance that that has in terms of determining your net worth and your wealth and your ability to build generational wealth going forward. And so when we're looking at how this Bracken Mortgage is a tech company first. We just so happen to do loans. We're looking at very innovative ways to be more inclusive for those categories of borrowers who have been historically kind of shut out. Part of that is educating them on the power that they have to be able to leverage where they are in life to get what they need in order to qualify for a loan. And even if you're not ready at that very moment, because again, it's all about being responsible. We're not trying to infuse any more risk into the system, but to make sure that borrowers understand that they have the ability and the power to be able to engage in this process, and they're partners with us and other lenders in this same space to be able to accommodate and accomplish those goals. So one of the things, again, when we're looking at the use of alternative data, we want them to understand that the power that has. You know, my grandmother would always say, people might not know if you're hungry, but they'll know if you're homeless. People are going to pay their rent. And so if you're going to pay your rent, why shouldn't that be counted as part of your ability to pay your mortgage? So that's the kind of thing that we're looking at it from a very common sense perspective. There's a difference between a borrower being risky in and of him or herself, as opposed to a loan product being risky. And so that's why when you're looking at alternative data, a lot of the things that we thought were so kind of like risk averse to because of the previous housing crisis 10 years ago, those things don't necessarily exist today. And we have to be able to be willing to engage with the government regulators and educate them on why this is important. Because to the earlier point that was made, you have more borrowers that are of color that are ready, mortgage ready and mortgage ready or eligible to get into that space. So there's no reason why we should be afraid to broach the subject of being more inclusive and using the data and leveraging the data and information that we have to be able to allow them to responsibly access the credit that we know that they can do good things with, particularly when they're trying to get into the home ownership space, if that makes sense.
Yeah, thank you so much, Sheree. I really like how you help us to really understand how, when we're talking about home ownership gap, we also need to focus on data gap. Like you talk about alternative data, and then relative to what the current industry standard is about the data that are actually captured and being used, right? And, following up on what Phil said about what the current landscape looks like for, mortgage market, and given the diversity, the new diversity trends based on the US Census data and from great insight that Phil actually shared. So I think my next question, that brings me to my next question, which is for Ethan. So I'd like you to please share with us the role that FICO plays in ensuring that this data, alternative data that Sheree mentioned, predictive models and other various modeling approach do not act as barriers or impediments to mortgage access. And in addition to that, if you also speak to the role that privacy could play, because I think I heard Sheree mention repeatedly use of these alternative data or even some of these predictive models and techniques responsibly. So when it comes to the role that privacy plays, if you can speak to that, I think that would be great too. Over to you, Ethan.
Sure, thank you, Dr. Akinwumi. Very pleased to be here to discuss the ways AI can drive greater equity in the mortgage market. I want to start by saying I completely agree with Sheree that alternative data is a critical part of this, and AI has a critical role to play in the use of alternative data. To set the stage for that, I think it's helpful to first highlight where AI isn't necessarily able to help. And that is when it comes to trying to generate an accurate risk assessment on populations with insufficient data available. There's really no analytic modeling technique, including AI, that can solve what's really a challenge of insufficient recent information about a borrower's financial profile. And so I mentioned that in the context of claims that other credit bureau models can score out millions more than the FICO score currently used by the enterprises, because I think through the lens of really driving credit inclusion, it's so critical to ask the questions, what is the credit profile of these consumers? And what kind of score, what kind of opportunities would we really be generating for them? So with that, I had a slide to share. Hopefully people are able to see this. But what this table presents is the key subsegments of the US population that are not scored by the FICO score widely used in the mortgage space today. And they're not scored because they are all segments that only have very sparse and or stale credit bureau information. So we refer to this first subsegment as the lost access to credit group, because this segment has serious delinquency showing in their credit file and no recent credit activity. If you score these consumers out, there's some 16+ million of them using credit information that's on average 3 or more years old. Are you going to help increase credit access? Our belief is no. Our research indicates that you're going to assign scores in the 500s and below, and it's based on an outdated snapshot of their financial profile. So you're in effect increasing the likelihood that these consumers will be auto-declined by lenders and further locked out of the credit mainstream. The next subsegment, known as the credit retired, there's no sign they've ever had difficulty making their payments as agreed, but they haven't used credit recently. And not surprisingly, this population skews elderly, median age of 73. It's worth noting that this is the segment where a majority of the 620+ scores would come from. But again, this is based on data that's almost 5 years old on average. Barack Obama was president 5 years ago. A lot changes in 5 years. And perhaps more importantly, generating a score on this population isn't going to substantially increase credit access or equity because very few consumers in this segment have any interest or need for credit. Next, we have the new to credit segment. This is a noteworthy population just starting their credit journey. And here I would quote my third grader, who often talks about the power of yet. These consumers have very new credit accounts, less than 6 months of experience, and they don't yet have a FICO score. Again, yet. They will in just a matter of months. All that's needed is the 6 months of demonstrated repayment behavior that our analyses show that's needed to drive a robust and reliable assessment of that borrower's risk. And we haven't even mentioned the single largest segment of this population, the credit invisible, those with no credit file at all. The CFPB assigns this segment as about 25 million US adults, and this segment is completely unreachable using solely credit bureau data, as these consumers don't have any. So when Sheree talks about the value of alternative data, again, when I say FICO believes in that, we have spent years, over a decade now, researching and developing new scores that leverage additional data that helps us to understand who among these segments are in a position to successfully repay on a mortgage. And in order to do that, you have to be able to build a more robust understanding of these consumers' risk profiles. And again, the way to do that is by leveraging information found outside of the traditional credit bureau data, whether that's payments on telco accounts, utility accounts, checking and savings account, cash flow information. We live in an era of unprecedented amounts of these new sources of data being available. And this is where I feel AI offers great potential. It's a powerful tool for quickly and effectively identifying which data sources hold the greatest promise for improving our understanding of borrower credit risk. And if we can improve our understanding of the risk, we're in a position to find consumers who today might be deemed high risk, who with the use of those additional data sources can actually be understood to be lower risk and in a position to successfully manage credit. So to sum up, building more inclusive models is about using more data, not less. And a key benefit of AI is its ability to quickly and accurately separate the wheat from the chaff when it comes to evaluating new data sources, finding the meaningful risk patterns in them, and helping to identify those sources that will move the needle when it comes to increasing credit access to historically marginalized and underserved groups. Michael, to your second question, I'll just really briefly say around privacy. I think Phil mentioned consumer contributed data. I think that's a very noteworthy recent development, is putting the power in the hands of the consumer to decide what information they are willing and able to share in order to drive a more refined credit risk assessment and ideally qualify them for more credit. By putting that responsibility in the hands of the consumer, you give them the ultimate choice and decision to make about what information they would like to share.
Thank you so much, Ethan. Thanks for breaking down the segment of group of consumers that are traditionally going to be creditor invincible. And thanks for sharing your thoughts on how AI or machine learning could actually help to make those segments become more visible. I'm very sure that I'm going to have follow-up questions, in particular for you and Phil. But my next question is actually for Ted. So now, the previous panelists, they talked about the role that data, alternative data, and even traditional models could play in making sure that we serve the interest of people of color, and more importantly, making sure that we have a mortgage market or housing market that is actually equitable. So Teddy, Zest AI is known as an advocate for use of AI in lending and other markets where ranking is feasible. Could you please address how AI is different from what we traditionally work with, and why you think AI would work better for lending, especially for transparent, fair, and equitable lending? And also feel free to share real data to support your comment. For example, how many people of color will actually get more access to credit this year as a result of using some of the technologies that you have at Zest AI? Over to you, Teddy.
Certainly. Thank you so much for this opportunity. At Zest AI, we are focused on using AI to actually assess credit risk on behalf of our customers, who we serve everyone from large entities like Freddie Mac and Truist to small credit unions in small rural areas in Alabama. And we have found that the use of AI to assess credit risk makes all the difference for women and people of color. Legacy scoring systems assign risk scores to African Americans that are 100 points lower than whites on average. Half of white Americans have credit scores over 700, but only 1 in 5 Black people are given credit scores over 700. We think that's a travesty, and we think we have a moral responsibility to do better. And the way AI helps with that is that it can first consume and use and make use of more data. So it's great to find new data sources, but if you are using, 3rd grade math to assess the data, you can only consider 20 to 25 variables at a time. And if one of them is missing, the model doesn't do very well. Whereas a machine learning model can analyze 100, 300, 1,000 variables at a time. And so if a dozen or 2 dozen of those variables are missing, the model still has plenty of information to work with to assign an adequate risk score. The second reason why machine learning makes for a better credit score is that it does more robust analysis of the data that is available. You know, if you picture a screen with white and yellow dots on the screen and they're scattered everywhere, and you're trying to just sort of separate one group from the other, that is folks that might default from folks that wouldn't, and you're just trying to use a straight line, you're going to make all sorts of bad calls. But if you could use a curved line, if you could use advanced math to identify those that are likely to repay and could benefit from credit, you're going to find more borrowers to approve. The third reason that AI is important is that AI can be explained. You know, some legacy methods, the models are not transparent. They're hidden behind a firewall and no one can see them except the modelers themselves. Whereas AI models, because of the regulatory scrutiny that has come to bear, and rightfully so, you know, at Zest, we produce a 300-page report for every customer that lists every variable in the model, explains exactly how that variable will behave using explainability methods that can be demonstrated with mathematical certainty to be accurate. And so when regulators come in to examine customers using Zest models, they are astounded by the amount of information that the lenders have about the models that they're using and about how they impact and improve the lives of real people. And I would just say the fourth issue, which I know we'll get into a little bit later, is fairness. Machine learning models are more fair because they expand access to credit. And Zest, we invented a patented technology to make them fairer still by using advanced machine learning to run thousands, millions of experiments to try to see how we can treat the variables in the models differently so that we can be even more fair. So no longer are we left with models where we just say, well, this is the best we can do with the 20 variables in third grade math. Instead, this advanced analytics allows us to expand access to credit and improve the outcomes for minorities, women, and other disadvantaged groups. And we forget that they're real people sometimes. And that's what I'm most proud of being at Zest. Thank you so much.
Yeah, Eddie, thanks for speaking on how AI could help to make sure that some of these scoring solutions, they are transparent, they are fair, equitable. And this actually brings me to the open questions that I have. So Phil already talked about what the current opportunities or potentials are, right? And also some data that we could actually consider or leverage to make sure that we have AI solution or AI systems that make our housing systems to be more equitable. And Sheree talked about the role that alternative data could play. And even from the slide that Ethan shared, right, how he broke down the different segments of credit invisible. And Teddy also, you spoke to how AI could help to actually make the traditional credit invisible more visible. Now, my first open question is, because when it comes to home ownership gaps, right, we need to consider the role that data plays. And one of the panelists already talked about how scanty or how underrepresented people of color or even other underserved communities are in the current mortgage data. So my question is, how does AI allow us to fill these gaps for people, for example, that are new to credit, people that have thin credit files, so that at least we can expand the credit box?
I think one of the things that we have been examining internally from Racket's perspective is how we can reach or use the technology that we have to reach the underbanked and unbanked, because part of it is not just about getting, borrowers who are right now ready and eligible, but honing in, using HMDA data, using the mortgage call reports, identifying census data, using those tools that we have to try, not necessarily, I hate the word target because that's so loaded and layered, and it's not the thing that we want to make it come across that we're just like seeking out, people because of their race or ethnicity, but figuring out how we can find pools of borrowers who fit certain criteria that are credit invisible, that don't have, they're thin file borrowers, or also unbanked and underbanked, because that is educating people on the power that they have to take control of their finances. And it's not as scary as a process as it has traditionally been. That's a huge educational lift. I think that's part of the problem that for so long, and this was it's inherently built into our financial services system across the board from a historical standpoint. If you think about the way credit policies have been written, the way lending has been written, the role of redlining, the role of how we even have fair lending rules to begin with, that is all rooted deeply it's built around the exclusive purpose to create a divide to the generational detriment of people and borrowers of color. So we really have to start to think about non-conventional way or unconventional ways of unpacking and bridging that divide. And it's not necessarily about how can we sell them a mortgage product, but is it how can we give them a holistic approach and using the technology that we have to show that they can be part of the process too. So just opening that door is half the battle, and then inviting them to come in.
Thank you. Go on, Teddy.
I was going to say that's such a powerful point. To say that because a group of people didn't get credit in the past or doesn't have credit now, we're not going to give them credit now, credit in the future. I mean, that only exacerbates the problem and makes things worse. We have to find a way to look at folks holistically in order to understand, can this person afford to repay a loan that we might give them? And we have to be willing to do that and to use advanced science when it helps us. I think the more data point is an important one here. There are plenty of customers plenty of lenders. There are customers, plenty of lenders, for example, that might be giving a credit card to a borrower, even if it's a low credit limit. And if that borrower is repaying every month, that data might not be somewhere else, especially if they're using a fintech or something like that. But if we get access to that data, that is a relevant factor in determining whether this person should be given the opportunity to build wealth by getting a mortgage. You might also look at alternative data sources at Plaid and other folks that other folks out there who are offering compliant, reliable sources of data. And I'll say it one more time. I promise not to say it too much more often, but the fact that machine learning models can use the extra data is so critical. If you're stuck with a modeling technique that has 25 variables in it, or whatever it is, in the teens or 20s of variables, it's just not going to be able to consume the additional data sources that are available today. And so I think those things are really going to help fill in the gaps for people with thin and no credit files. When you can consider 300 things about a person instead of 25, you're gonna find what you need to make an accurate risk assessment.
Teddy, don't you think that also piggybacks on the fact that we can eliminate, keeping it narrow also leads to the unintended consequences. Sometimes it can end up being biased because over time, the way things change and shift, is that, you start to, you can push the needle too far in one direction. It has an unintended consequence of shutting people out as well. So that's part of it. It's just like making sure you're keeping it open. So I love that point about just saying, the more we can get, the better, so that you're not, being narrow.
That reminds me, so when I grew up in Maryland, I'm in SoCal now enjoying the sun, which is blinding me, by the way. But I grew up in Maryland, and I grew up and it's a really interesting spot where I grew up. There are two counties that sort of are right on top of the District of Columbia. One is Montgomery County, which skews rich and white, and the other is Prince George's County, which skews actually rich and Black. But, and so I grew up in Prince George's County, But when you look at the homes in the two different counties, in Prince George's County, there are hundreds of thousands of dollars less than a home in Montgomery County for no reason other than that. I mean, no apparent reason other than that, there are more Black folks in one county than the other. And it is something that really has driven my passion for these issues because, again, that's hundreds of thousands of dollars of wealth essentially stolen from a Black community when they're both the same exact distance from the Capitol building, the same exact distance from K Street. There's no reason for this. And so finding ways to solve this problem is of critical importance.
Yeah,
Michael,
thanks.
may I
Sorry,
add
go
just
ahead,
one other comment about, when we talk about the credit invisibles of America, I just want to make that point that none of us want to do things that would potentially extend credit to people that are not sustainable and not credit worthy. But it is clearly important that we should stop the practice of not providing opportunity for those people who are working to get themselves credit worthy. And frankly, I hear this a lot. It's one of the reasons that I'm proud to work at VantageScore. We can provide a credit score to almost 96% of the adult population in America. I didn't say that all of them would be creditworthy, but those people, like the 37 million that can't get scored through other sources of score providers, those 37 million people are in the underworld of credit activity in America. They go to payday lenders and other the other underworld of borrowing. They have credit needs. We have to provide them opportunity to get them on the track of mainstream credit. Not all of them are credit worthy now, but if we don't provide them a vessel and a vehicle and an opportunity to polish themselves and get ready for any kind of credit extension, and the use of machine learning and alternative data, and I might add, safe, secure, and protected consumer permission data, we can provide better alternatives for these folks, and it's incumbent on us all to do that.
Yeah, thank you so much, Phil, for sharing your thought and your insight, especially emphasizing why it's important to actually for the industry to revisit what it means to be truly credit worthy, especially in this era of alternative data and also new or novel machine learning or AI algorithms. I think that brings me to the next open question, and I would really like Ethan and also Phil to comment on that. So traditionally, when we talk about model risk, right? So the focus is usually on risk to the financial institutions. And Phil, you had mentioned reasons why some people of color don't have access to the mainstream financial market, right? And what usually happens is that they turn to predatory lenders, right? So balancing risk is the main objective of lending organizations looking to serve traditionally underserved markets. And the risk here involves both model risk, let's say product risk, and also consumer risk. So Ethan and Phil, how can AI and ML help balance risk while expanding credit access to everyone?
Well,
Go ahead, Ethan.
Thank you, Phil. I think it really centers back to my opening remarks again. AI can be used to help us identify new sources of data that we can bring to bear on those historically underserved populations that don't have sufficient information in their credit file in order to derive a robust and reliable assessment of risk that, again, will allow lenders to appropriately balance the risk and ensure that they have confidence in their underwriting strategies used on those populations. So I completely agree with Phil that we have to find a way to score these populations that have insufficient traditional credit data. I think where we perhaps depart is that FICO's firm belief is that the way you do that is by bringing additional alternative data to bear, as we have with our FICO XD, with our Ultra FICO products, that in net actually score out even more of those traditionally unreachable consumers.
Teddy, excuse me, Michael, I might just add that, to Ethan's point, frankly, when you think about alternative sources of data, years ago, when I was actually in the direct mortgage business, years ago, we used to use rent information and utility information to make underwriting decisions on consumers. It is highly unfortunate that less than 1% of rent data is reported to the credit bureaus and therefore accessible by the traditional scoring models. It is an impingement of opportunity that we must solve for in America. When you think about a consumer that's paid rent on time for 4 or 5 years and gets no credit for that in the traditional credit bureaus because the landlords don't report the rent data, it's we have to get access to that information to be able to lift these people into to provide the scoring and the ability for them to access credit that they deserve. And so let me just mention, frankly, that if we can't get landlords to, there are some some legal restrictions and some other just operational logistical reasons that landlords have difficulty reporting rent data, positive rent data. They do report the negative rent data, that's for sure. But we need to get them to report the positive rent data. And if we can't do that in a systematic way, and there are barriers for all of that, and maybe that's a 10-year crusade that we need to embark on. But there are other ways to get access to the data. And as I mentioned, getting access to consumer permission so that we can examine the banking accounts from consumers and other accounts so that we can validate in a transparent and safe and secure manner income, assets, obligations, and employment, and that which would include rent obligations. And we could validate those things. Though that is so essential for us to open the door for this broad swath of consumers that are really underserved, and it's not their fault. That paradigm must be shifted, and we're all working really hard to do that right now with other means and other sources, whether it's artificial intelligence, machine learning, consumer permission data, and other things. And I know we all have the same thing in mind. Reaching the consumer that is rather underserved, has traditionally been underserved, and doing the right thing to provide as much lift for them as we possibly can.
I think the thing that you just pointed out, Phil, is that we have to remember these are people. This is not just like, a kind of like nebulous construct that we're talking about. We're talking about real live people who could benefit from this. And when we stop looking at it as just numbers on a chart, the data represents actual people. And so, how do we make sure that as long as we're doing the best thing that we can and operating from their best interest, that part is what's going to drive, the moral tag to get us where we need to be. So when I heard what you just referenced, it was amazing, because my first thought was like, these are whole people that we're talking about. We're not just talking about it in a vacuum. So that's just refreshing to hear, just from a credit scoring point of view.
Well, and let me, Sheree, just let me add one little point of reference about that. Just think about the consumer that pays their rent on time for 3 or 4 years, pays 6 different utility bills on time for 4 or 5 years. None of that information is reported to the credit bureaus, and so we can't score it in a traditional sense. And maybe they have one auto payment that they had a little hiccup on at some point in time, and that's the reference point. It really is unfair, and it's impractical, and we have to change this paradigm, and I know we're all working hard to do that.
Thank you for highlighting why it's important to actually bring in conversations about data to balance the different risks, especially model risk and also model risk and also consumer risk. And that brings me to my next question. So there is, at least from my industry experience, the moment you mention AI, machine learning, or even alternative data, the very first button that I think is actually clicked in people's mind is, the Great Recession. So there are a lot of skeptics out there that are concerned that when you start talking about AI, blending it with alternative data, then that will lead to unsustainable lending practices. And what we know for a fact is that this is a myth, right? So what makes this technology different, and how is it now different from the issues that led to Great Recession?
I'd be happy to.
Michael, it's Phil. I'll take a quick, and then I'll turn it over to Teddy. We have done a really bad job of making sure that all of America, policymakers, consumers, advocate groups, et cetera, make the distinction between credit risk and product risk. The product risk is really what drove the Great Recession. We had products that just were, I think, have proven to be abusive and predatory. Those things like stated income, negative amortization, prepayment penalties, all kinds of things that just did not didn't serve the consumer effectively and appropriately. Credit risk is different, and we have the transparency and the way to validate and inform those decisions on consumers. And it's not the consumers that were bad; it was the products that were bad that led to much of that crisis.
I think that's such a powerful point. And at Zest AI, we've had models in production being used to make loans throughout for the last several years. And one of our first customers was an enormous bank in the United States. And during COVID, we love them to death. But they made us basically sit a person in a chair and watch the model monitors constantly throughout COVID and refit the model constantly by adding in new data. And what we found was, as we were doing that analysis throughout COVID, the model was perfectly stable. The Fed has recently issued warnings about some other scores that are actually getting less and less accurate and got less and less accurate throughout COVID, and others about how during COVID, some credit scores went up for everyone across the board for no apparent reason. Our models and our monitoring showed that the machine learning scores were completely stable, and it's because they rely on more data and more data points. And so the idea that machine learning is somehow the thing that's going to cause the next Great Recession is overblown. I would add also that machine learning models are backed by documentation. So there's a 300-page report with every model that explains exactly what you can expect it to do. And then when you monitor the model, you can see if it's doing what is expected and make a change very quickly. So I would say, for those reasons, because of the increased accuracy, because of the thorough documentation and explainability and the stability point, these machine learning models are fully safe to use in underwriting. And I'll add one more little anecdote. One of our other early clients was a bank in Turkey that started using our product just before Erdogan took over. And so they had a massive currency devaluation. Their financial markets were all over the place. The model was perfectly stable. That bank survived and thrived because they had a machine learning model in production backing the loans that they made. And so there's just we know mathematically why machine learning is not going to be the problem, not going to be the cause of the Great Recession, but we also have proof that it will not.
I think, sorry, Mike.
Over to you, Ethan. Yeah.
Oh, I would just add, I think it's critical with machine learning models that there be careful oversight and monitoring of the models at the very least, to ensure that they are continuing to perform as expected, because they are made up of thousands of variables, because it takes 300 pages in order to articulate the model. There can be all kinds of things baked in to the risk patterns of the model that can lead to overfitting, that can lead to challenges associated with patterns that fluctuate over time. So again, monitoring is going to be a critical part of machine learning driven models. And when it comes to the FICO score, It's very intentionally built as a very elegant model that doesn't use thousands of variables. If you give me a credit report, I could calculate someone's FICO score in about 20 minutes. Not that I want to do that on a regular basis, but the power of that is the ability to really peer in directly to the model and be able to very clearly articulate, these are the 3 variables that drove your score. If you did this differently, your score would be able to go out by this much, and say that with absolute certainty. And we leverage that insight, the efficiency and elegance of the FICO model to drive our consumer education and empowerment. Tens of millions of consumers have access to the FICO score on a monthly basis. And what hearing Sheree talk about, lowering sort of the digital divide and the barriers around understanding and empowering consumers has me continuing to think about how AI might help us continue with conversational AI to drive better education and explanation and empowerment of consumers around what their credit report is, what their credit scores are, how they're calculated, and how they can improve them. That to me moves the needle on credit inclusion as well.
That's certainly.
Sorry, go ahead.
I was going to say that's certainly a good point, and that the Zest AI software has model monitors built in, so that we are fully aware of what's going on at all times, and also by disclosing the variables to the lenders, they know exactly what's going on and exactly which variables are most important. So when they deliver adverse action notices to customers, the customers are fully aware of what they can do to improve their scores. So those are 2 critical points you made, Ethan. Thank you.
Ethan and Teddy, thanks for emphasizing the need to monitor these models, right? Because it's really important for us to ensure that we have stable solutions deployed to that actually impact customers, right? So it's important to monitor both the score and also the features, right, that go into the what's going into the model. Because one thing is, once you deploy the model, it's actually changing the business environment. And at least recently, NIST put forward a framework for monitoring AI risk, right? Or even identifying and also managing bias in AI systems. And one of the points that was actually emphasized by our advocates is the need to actually listen to the business environment once the model is actually deployed. And I thought it was really interesting to hear from your industry viewpoint that it's important to also emphasize the monitoring aspect. Because once you deploy the model and then you refuse to actually monitor it, then what you're saying is that, well, the model never expires, right? And one of my, a wise saying or quote when it comes to AI or machine learning models is that all models actually expire, or all models are wrong, but some are useful. But the way you actually measure or quantify the usefulness is trying to listen, you monitor. So thanks, Ethan and Teddy, for emphasizing that. So we focused a lot on technology, right? So, and it's really important to also understand the regulatory constraint, right? So what challenges does the current regulatory environment present for emerging technologies like AI, machine learning, or even using alternative data? I'd like you to actually speak to any regulatory constraints or challenges that we have about using AI, machine learning, or alternative data to make sure that people who are known to be credit are invincible become visible.
I think the biggest thing that we have to recognize is the limitation that we have right now in the regulatory / legislative space. There are no hard and fast regulations around artificial intelligence in general. We are still using and depending on the fair lending laws that have not kept up with the advancements in technology and the rapid nature in which we've developed all of this software to try to combat and support or combat things like bias and support, fair housing and fair lending and equitable initiatives in that space. So part of that is that there is a lack of, regulations in that area, but that's also a gift and a curse because we're still very constrained by, as one of the largest lenders that engages with the GSEs, we are very constrained by what they require us to do and what they allow us to do and what not to do. And part of that is driven by the conservatorship that they're under. They're not, there's complete prohibition on infusing risk into the system because of the fear of what happened, 10 years ago. And so when we're looking at trying to move the needle, part of that is also educating the regulators on how we're playing in this space as innovators in the business. Like, listen to the business, listen to how we're doing these things and how we're innovating, and also trying to bridge the gap to let them, or to teach them that, part of understanding how this will help is really more practical than it is scientific. You can't ignore the science. Using AI, using any type of algorithm, any type of statistical computer, anything, it's a science to that. But also when you're talking about the practical nature of what we're trying to do, as a business, we're not trying to run out here and play fast and loose. We want to make sure that we are, operating within the guidelines and the guardrails that will keep us in business, so that keep us, within the legal confines of operations and things like that. But also we want to make sure that we're being very practical and pragmatic with our regulators, so that they understand the significant role that they play in allowing us to engage in certain spaces, whether that's creating some type of sandbox, whether that's allowing us to develop in new and innovative and iterative ways that, I hate to say this, but there are always risks of mistakes. I mean, the risk is always there, but we operate within a margin where we minimize that by doing the right thing all the time and making sure that we're monitoring the use of data, monitoring the models, making sure that we're not, moving too quickly. You're doing test cases. You're playing it safe in a way in which it can be scaled and replicated. That way it can be beneficial. So I think that's one of the hindrances in the regulatory space. I work with our government affairs team regularly, and when we're sitting in front of our regulators and members of Congress trying to explain this to them, they're like, what? They're not clueless, but they're definitely not comfortable, because they have this inherent fear that there's going to be some kind of destabilization of the economy in that way. So we want to make sure that we're just being very mindful of our education to them as well as the consumer, so that we're being very inclusive, if that makes sense.
Michael, I'd like to make a point that Sheree just referenced that's really important to all of us. When we talk about regulatory and legislative barriers, just think about this. I started this by, the Harvard Joint Center for Housing tells us that 80% of the new household formation in America over the next 20 years will be people of color. The homeownership rate in Black America is roughly 43%. And that obviously tells us that the great portion of that constituency and the Hispanic population and many other, are renters. Any barrier that is imposed by regulation or state law or state regulation or state imposition or municipal imposition about the reporting of rent and utility data is just unacceptable. And policymakers must understand that we will not serve that need effectively unless we break down those regulatory and legislative barriers. And that is a strategic imperative for all of us.
That's such a powerful point. What we've experienced at Zest AI is that there are no regulatory barriers to using machine learning to underwrite consumer loans. There are some myths being perpetuated in the marketplace, but they are just that, just myths. And the regulators, I think, understand that. There are two main issues. One is ECOA, which requires lenders to provide consumers with reasons if they're denied credit. And when you can explain a model with mathematical certainty, you can comply with ECOA by giving accurate denial reasons when someone is denied. And then the second set of laws around fair lending. And the models that fit with existing regulatory requirements work really well. And I hope to talk a little bit later about fair lending technology that amplifies the fairness of machine learning models. But it exists, we have it, and we're using it right now in the marketplace to help lenders make trade-offs that make sense to improve fairness. And as Zest AI, we're a supervised service provider to financial institutions. And so we keep up, long-standing cordial relationships with all of the key regulators. We're often asked to come alongside our customers during OCC examinations. And when when the exam teams are there looking at the models, they understand them. They understand them better than they understand some other things out there. And they see the great results that they're producing. And so, when we talk about regulatory challenges, it's important to comply. Compliance is critical and an essential element of expanding access, but there's no barrier. It's just you have to know what you're doing and do it well.
Yeah, Teddy, Sheree, and Phil, and also Ethan, thanks for speaking to what the regulatory challenges are. And I thought it was really interesting hearing Sheree about how the fair lending laws, right, are trying to catch up with AI algorithms and all that. And this brings me to my very last question, and it's about fairness. So generally, when you, from what Teddy mentioned, ECHO and even FHA, all right, the Fair Housing Act, right? So testing has been an effective method for uncovering discriminatory policies and practices in lending. So when it comes to AI and machine learning, how do you think these traditional testing practices could be applied or adapted to AI and machine learning?
I'd love to jump in, but I don't want to jump ahead of anyone.
Let me just say, I know that all of us that provide credit score models to the marketplace do incredible deep dive fair lending assessment testing of all of our algorithms, our test points, our characteristics, et cetera, to ensure that there is fairness across the marketplace.
I just add to that we engage in routine, very robust testing from an internal standpoint through of all of our models, because the one thing that we have discovered is that the unintended consequence of some things can be the result of bias. And so with that being said, we approach bias as if it is a chameleon. You won't be able to always eliminate it, but you can eliminate the risk of it affecting the way you are operating your lending practices. So, it requires a lot of robust testing, and that's something we do routinely and regularly to make sure that we are not only compliant, but we are ahead of the curve.
That's such a great, thank you for that great ahead of the curve. At Zest, we did a lot of testing with our clients, and we actually got tired of just testing and seeing bias and not being able to do anything about it. And so we invented a fair lending technology that allows our customers to do just that. I've shared one slide today, and it's just this one here. And what you're looking at on this graph, every dot you see is a model that we're just rating on accuracy along the bottom and fairness along the y-axis. And what you often see is you have an older modeling technique like that gold dot there that is kind of accurate and not that fair. And then older techniques that you might use to mitigate the disparity caused by that model leave you with something that's barely any fairer and much less accurate. So what we did is we applied machine learning to run a search for less discriminatory alternative models. And what we do is we search the universe of hundreds of thousands, millions sometimes, of potential models that you could use. And we arrive at this efficient frontier of alternative models. And if you notice, all of them are more accurate and most of them are more fair than the one that the lender had in production. And what's even better is that the trade-off between accuracy and fairness is extremely tiny, which means when a lender moves to machine learning, they can give something back. There's so much more room in the accuracy bucket that they can actually give a little bit of that back to amplify their fairness to the point where there's almost parity between the way African Americans are treated relative to white folks or women relative to men. And this technology is so powerful. Our clients are using it. One customer, just a quick anecdote, and I'll cede the screen back, but a quick anecdote. One customer, by giving up $40,000 in increased profit, so they're going to make quite a bit more by using machine learning, but they were able to give back $40,000 and increase the fairness of the model that they used to a point where it's considered fair under fair lending laws, over 90% adverse impact ratio. It was amazing. That was real people able to get high quality credit when they would have otherwise have to turn to a higher interest product that would not have done them any good. And so we're so proud of the technology, and they're available in market, in use today by responsible lenders. Thank you so much for that question, Michael.
So that concludes this panel on AI and the future of housing equity. This is, obviously a very incredibly important topic. And I just wish that we had more time to, attend to follow-up questions. So, this topic is something that we continue to, speak about and make sure that, the industry actually eventually becomes open to, the underserved, traditionally underserved community. And we're excited to actually see where the technology can lead us or take us. So today's final panel discussing expanding broadband access is coming up at 3:50 Eastern Time. We hope you can join us for one last discussion. Thanks to our panelists. Thanks for sharing your insights, your wisdom, and also your experience. But more importantly, thanks for being open to making sure that we can use AI or machine learning responsibly to ensure that or assure that housing equity is for everyone. Thank you.
Thank you.
Thank you.